Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One strategy you might diversify your investments is trading low correlated instruments. So what is it? What's correlation? Well, there's a lot of ways to look at it, and I only have just a brief few moments to go through this presentation, so I'm not going to get into the serious math behind it, but let me give you a couple of definitions. Correlation is the strength of a linear relationship between two variables. An even more practical definition is the relationship of how one asset moves in relation to another. For correlation to exist, it must be somewhat linear in shape, and I'm going to show you some charts at the end of the presentation. A perfect correlation would be 1, and a perfect inverse would be -1. ISE FX options may offer low correlation. So considering the versatility that the listed options market provides, investors might want to use some of their most popular option strategies in the ISE FX options market to reduce correlation risk. Traditional currency roles, hedging currency risk, especially lower yielding bond investments. Trading currencies more to enhance returns of the portfolio. So what you're trying to do is you're trying to think of, okay, maybe the equity market explodes to the upside a couple of years ago. Now you're saying, well, you don't think it's sustainable. That's up to you as the investor. But you can look into the currency markets and find maybe other pairs that maybe are just beginning a new bull market. That's the whole idea of it, that you can hopefully move from asset to asset, or just diversify your portfolio by owning a little bit of many different instruments. Currently, some experts believe that the currency is an alternative. The foreign currency market is an alternative asset class. Why are currencies gaining in popularity? Well, lower interest rates make currencies an attractive asset class for diversification because currency investments tend to have low correlation with equities and bonds, and currencies also tend to have a low correlation to systemic risks inherent in the market. So while it just some currencies that actually had a pretty high correlation to the markets, and others had a pretty low correlation. So you want to understand how all that works. Governments are going to intervene. In fact, we've seen more government intervention in the last 4 or 5 weeks than we've probably seen in 4 or 5 decades. Is this something that's going to continue? Many say yes, some say no, so we'll see how that all works out. Market information tends to be viewed in different ways, creating opportunities for market participants. Political pressure from various entities can sometimes encourage central banks to act in ways that are not consistent with market forces. Why trade with a reduced correlation? Well, let's first assume you have a few strategies that you find very compatible with your own goals and your own risk tolerances. Instead of increasing your equity market risk with additional equity options positions with amplified position management risk, if all your positions move alike, you can actually use some of your favorite option strategies to reduce your correlation risk by trading ISE FX options. Historically, the FX market has had a very low correlation to the U.S. equity markets, although obviously that can change. So low correlation, what does it mean? Well, correlations can change. Investors must be aware that these relationships may and will change as markets receive new information. And I'll talk a little bit more on that in a brief few moments. ISE FX options are dollar relative, meaning what is the U.S. dollar worth relative to another currency? Since the ISE FX options are dollar relative with the dollar as the base currency, the following relationships hold true. Dollar rising, ISE pair value will rise, calls should rise. Dollar falling means the ISE pair value will fall and puts should rise. Strategies to use. Again, Jason Ayers will be on next week talking more about this. And if those of you are going to be listening in the future, just seek out Jason Ayers' presentation on strategies to use when trading FX options. but investors can buy calls to hedge their non-U.S. currency risk. Investors can buy puts to hedge their U.S. dollar exposure. Call spreads and put spreads, you can use debit or credit spreads. Volatility trades can be implemented, and even limited risk selling methods such as credit spreads can be created. Let's look back historically. We want to know where we've been, so at least we can get some sort of idea of, people always say, is the dollar expensive or is it cheap? Well, it's going to depend on the period of time that you're comparing it to. So obviously the dollar is not worth nearly what it was against the yen in 1971, and then many would say that it might not ever get back to that spot, as the U.S. dollar has taken quite a beating in the last 20 years. Swiss franc, just about every period of time, the U.S. dollar seems to be worth less against the Swiss franc. We take a look at against the British pound. If we take a look at against the pound, well, it's pretty much been the same, although in 1985 the pound was very, very strong. I'm sorry, the U.S. dollar was very, very strong. But recently it's been trading at the same level pretty much, around 50, 60 cents. The Aussie dollar, though, this is interesting. The Aussie dollar has moved, U.S. against the Aussie is moving all over the place. In 1985 was trading at $1.49, which many would say was sort of the heyday for the U.S. dollar. And it's actually trading pretty close to that today. So that is interesting, that the U.S. dollar is trading at its 1985 highs, or pretty close to those highs, against the Australian dollar. So for those of you that believe that the U.S. dollar might weaken against the Aussie, well, maybe there's some strategies out there for you. So for those of you that think that the U.S. dollar is going to rally even further and maybe could go to 155 or 160, well, there are obviously option strategies out there for you also. And if we look at the dollar against the Canadian dollar, well, the dollar has moved against the Canadian, has moved all over the place, anywhere from par in 1971. Actually went to a discount at the end of 2007. The U.S. dollar went to a huge premium there in 1985 and even 95. And now the U.S. dollar is actually gaining quite a premium against the Canadian dollar, at least recently. And the euro doesn't have a lot of history, so I just look back. You can take a look at the more recent history here. Shows us that the dollar yen is pretty stable, although I guess we're trading at a sort of the low end now recently. Dollar euro, pretty much the low end. Dollar pound, we're sort of trading at the low end of that one. Dollar Canadian dollar, we've seen the U.S. dollar was much, much stronger in 2001, worth about $1.54. I think it's worth about $1.18 today. Dollar Australian dollar, so even though we saw a new high in, let's say, or a relative high in 1985, the U.S. dollar actually peaked out in 2001 at $1.95. So if you're bullish on the dollar, you could actually think that, well, the old high was around $1.90.95. So obviously there's strategies out there for you. And recently, the U.S. dollar against the Aussie traded at around $1.02, $1.03 just 4 or 5 months ago. So there's been quite a range in the last couple months. Dollar against Swiss franc, well, the U.S. dollar has taken quite a beating against the Swiss franc. So let's take a look at the recent performance. I have a couple of dates, August 8th and then October 17th. So we look at in the last couple months, last 2 months, dollars rallied significantly against the euro. British pound is fallen dramatically against the yen, but it's rallied against the Canadian dollar, rallied against the Swiss franc, and rallied against the Australian dollar. So out of the 6 ISE pairs, the dollar has actually rallied against 5, and a couple of them significantly. Definitely significantly against the Australian. It's moved pretty significantly against the Canadian, and even the euro it has moved quite a bit against. So looking at the Bank of International Settlements in 2007, we see that 86% of all FX transactions had the dollar in the transaction. Now remember, if you add all these numbers up, they're going to have 200%. Why? Because we have 2 currencies in every transaction. So if you look at, let's say, the dollar, euro, yen, well, what does that add up to be? I don't know, around, I guess, 130. So if you threw in the pound, you'd say, well, 150% out of 200%. So, quite a significant portion of that, maybe 75% of all transactions are going to be either dollar, euro, yen, and pound. And so this is why you can see how important it is that we've traded, we're trading the majors right now. And the next major we'll probably add for this exact reason will probably be the Swedish krona. And that we have plans to add that pretty soon.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.